Okay, we're live. All right. Welcome back, investors, to Ticker Time News. I am Adam, and this is the place where smart investors come to learn. Now, the stock market made a rebound attempt today. There were some false starts, but ultimately it was successful, gaining some steam after the release of the minutes for the May FOMC meeting. Each of the major indices ended the day higher, yet the performance edge clearly went to small and mid-cap stocks over the larger peers. The Russell 2000 increased 2%, and the S&P Mid-Cap 400 Index, it increased 1.9%, versus the gains of 1% for the S&P 500 and 0.6% for the Dow Jones. Now, some speculative trading action and short covering activity bolstered the performance of these smaller cap stocks, but to be fair, today's session had a predominantly inbound or rebound, I guess I should say, minded bias that saw the major or majority getting my tongues twisted up here, right? Yeah, that was an odd word or phrase. Okay, shake out the nerves. Let's get back to this. The majority of stocks did see some buy the dip happening, right? There were some buy the dip activity going on. Now, the interest was evident in the advance versus decline margin, which favored advancing issues nearly 4-1 at the New York Stock Exchange, and better than 2-1 at the Nasdaq. That's pretty impressive. Yet, even with the broad-based gains, the stock market's problems did not go away overnight or with just one little meeting's minutes, right? Growth concerns continue to persist, evidenced by some weakness or weaker than expected durable goods orders for April. No growth in the weekly mortgage purchase applications, that actually fell. Luxury home builder Tome, my goodness. Get out the nerves, Adam. Get out the nerves. Okay, Toll Brothers, ticker symbol TOL. They posted their earnings today. They were up during the day. I think it was about 8%. Yep, 7.97% on the day. So it couldn't have been all bad for Toll Brothers. But Toll Brothers did acknowledge that demand has slowed down over the past month. And that's what we're seeing in the housing market. It is slowing down. The brakes are being applied. Then Dick's Sporting Good also reported earnings, ticker symbol DKS. They were up pretty good. I think 9.7, and another about 0.5% in the after hours. So why was this retailer up while other retailers found some pretty big damage earlier in this week? Well, they issued a fiscal year 23 EPS guidance that was well below expectations due to the expected impact of evolving macroeconomic conditions. Now, where have we heard that over and over and over this week? But other companies' earnings reports. So that did not go away. But those concerns, they seem to be set aside as market participants looked intent on forcing a rebound effort today. And that intention was most evident in the consumer discretionary sector. It was up 2.8% today, which has been the hardest hit sector this year, and which shook off the warnings from Dick's Sporting Goods. Now, unlike past sessions, when a when it reacted in a negative way, went down, right, due to any negative statements made or disappointing guidance that was put out by companies so far. So that seemed odd today. Now, most sectors did end today higher. The sluggish ones were utilities, but barely 0.06% down, and industrials 0.02% down. So relatively flat. Now, energy was up 2%, information technology up 1.2%. They fell in line right behind consumer discretionary as the best performing sectors. Now, gains for the remaining sectors range anywhere from nearly flat, 0.04 to 0.9%. Now, late in the day, the S&P 500 flirted with the 4,000 level. SPX is the ticker for the S&P 500. Let that load here. I'm going to do a couple things. Number one, I'm going to take this to the 5-minute chart so we can see today. Now, what you see here on the chart is yesterday, the gap down early in the morning yesterday, the fall yesterday morning, and then the rebound that pursued the rest of the day. And then we get halfway in the middle of your screen, we get to today. Now, today started off going up. We actually broke through a resistance level that had kept the S&P 500 down for a couple months now. And it broke through that. But it did find a little resistance, and it flirted with that line for most of today. It wasn't until the minutes came out from the FOMC meeting that the Nasdaq ran up to stiff resistance. And that is right here, nearly at 4,000. It actually got to 3,999 today. So really knocking on the door of that resistance level. But once it reached that point, the S&P 500 closed in a sell-off during the last hour or so. So you can see this black line that's on top right here. Let me just make it a little clearer for you right here. This area right there. That black line represents the 4,000 level on the S&P 500, and you can see how close it came to that today. Now, I'm going to go back to the daily chart so we can see what this looks like in the grand scheme of things. And I'm going to remove volume to make it a little clearer. Let's open this up. So you can see this purple line going down, right? And there's several reactions, several rejections at that exact line over the past several months. Today, though, it broke through it. But then it gets to this black line right at the 4,000 level. Now, when I scroll out a little bit, let's look at that black line and see where it's hanging up the market. We go back, it starts as resistance all the way back in July of last year, and then it turns into support during October of last year. And that support kicked off the rally that sent the S&P 500 to all-time highs. And then we get to February the 24th of this year. That's when we hit our second big low of the year. It bounced off that point. And now we're finding a rejection at that level. What's going to happen tomorrow? Well, anything's game, right? But since hitting that area of resistance, I suspect that the market might be going down, even though there is a lot of pressure on the market to have some kind of a short-term rally. And if it could break above 4,000, then we might be able to get that short-term rally that the market is desperately pleading for. Now, this 4,000 area, it marked the high of the day. And that was reached, again, about an hour. Well, I haven't said this yet. Within an hour of the end of the day. But it was reached exactly 1 hour after the release of the FOMC minutes at 2 o'clock Eastern. Now, market participants were presumably, I guess I could say, hardened by the notion that the Fed members want to move slowly to a neutral rate in a bid to quell inflation pressures. And that moving there quickly could allow the Fed to possibly hit the pause, tap the brakes on continuing to push up rates. Now, we know when the FOMC meeting occurred, Jay Powell said, and I have it written down here, a 50 basis point rate hike in June, a 50 basis point rate hike in July. But the September meeting, that could possibly be a 50 basis point rate hike as well. However, if it's not, if it comes down lower, that's going to be a pedal to the metal for the market. And we can finally start making some gains off of these lows. Because once rates stop going up, and if they pause it due to a slowing economy, that would be really good for the market in the short term. Not speaking long term here, only in the short term. So, a possibility of the Fed pausing on raising rates when it gets to that September meeting, and that September meeting is on the 20th and 21st of September later this year. Now, it's highly debatable that a neutral rate in the neighborhood of about 2.5% will be high enough to do anything to dampen inflation pressures. But it was just enough of a carrot dangling in front of investors today to create trading excitement, especially in the afternoon session. Now, notably, the 2-year yield, it barely budged after the release of the minutes, standing right at 2.5%, which I find kind of interesting. But remember, let's go to the 2-year here. US 02Y. The 2-year yield is sensitive not to growth concerns or inflation. The 2-year yield is sensitive to the Fed's funds rate. So, if the Fed is coming out and saying, well, once we get to 2.5%, we're going to slow down on rate hikes, the market loves that. The market enjoys that. That's like music to their ears. So that's a little of something that's happening today. And you can see that 2-year was flat today. It barely registered a candle at all. I mean, it's still sitting at 2.5% right now. It hasn't even budged. Meanwhile, stocks finished off their highs for some renewed selling pressure in the last 45 minutes to an hour for today. Now, I shared with our investors on Patreon this afternoon thoughts on what was happening in the market after the FOMC meetings were released. Why was there an upswing in trading? Why was the market going up? And I'm going to show you right here. Here's what I said. There are a few considerations that likely help drive the post-minutes upswing. 2 of them. Number 1, market participants like the idea at this point that the Fed wants to get to the neutral rate as quickly as possible. Doing so presumably would help cool inflation pressures sooner rather than later. And it's highly debatable that 2.5% is, what will pause inflation and bring inflation down. 2, market participants also like the idea that the Fed could be hitting the pause button on rate hikes before this year is done. That view was born out of the indication that many participants judged that a quick removal of policy accommodation would leave the committee, quote, well positioned later this year to assess the effects of policy firming. So, a couple things there about why we ended the day, or we rallied after the FOMC minutes came out. Now, if you would like this valuable information to help you along your investor journey, then come join us by clicking the first link in the description. We'd love to see you there. All right, Nvidia came out with some earnings today, and they were good, but one thing, guidance, right? And we've heard this for this entire, this entire earnings season. guidance has been the kicker for all these companies. NVDA is the ticker symbol for Nvidia. Nvidia missed, Adam. Oh boy, I wasn't sure. I wasn't sure how it was gonna work. It was up 5% during regular session. In the after hours, Nvidia has dropped 6.1%. It was a little bit worse than that. It had dropped a little bit more, but it's kind of settled here, down 6.1% in the after hours. It's right about the 159 share price, and that's really close to that buy box of sub 150. What did it actually get a low to? Oh, it's not going to show me because it's only showing me regular session. But anyways, earlier this morning, no, 154. So $4 off from that mark. Yeah, it can't be perfect, right? It never works that way. Okay, so with this, right now, Nvidia is trading, and I'm just going to circle it here on the chart. It's almost where the bottom of the candle is, but it's just slightly below it, right about here in that circle right there. So it's not that far off. I mean, it was up 5% today, so it's really just a percent lower than where it closed at 4:00 p.m. So it gave up all of its gains plus another percent in the after hours, which is still higher than this low hit back here on May the 12th, not that far away. That low, well, it's about the same, 155. So it's just a little fuzzy there. 155. All right. Okay, so let me just talk about Nvidia real quick. Just kind of finding some interesting things on the chart. Nvidia shared its earnings after hours, right? And the chip maker actually reported strong Q1 results, but shares dropped after the company issued weak guidance for the upcoming quarter. This has caused other peers like AMD to fall in the after hours too. And let me just pull up AMD right quick. AMD is the ticker symbol. I just want to see where they are right now. Down 2% in the after hour. Not that bad. Still in the buy box. They're at $90 right now. They were up 1.6% during the regular session. So they're still staying underneath their resistance line in the buy box right now. If they continue holding this resistance, then, like I called, next earnings report for Nvidia, which is not until July, I mean, this thing could be sitting around $80 a share. Not that far off. All right, back to Nvidia, NVDA. And let's look at this for just a moment. Now, even with Nvidia being up 5% today, it's still held underneath this resistance line for Nvidia. Now, this resistance line is a little bit tricky because over the last quarter, the past couple months, it did break above it pretty significantly at the end of March when we had our snapback rally, and then slowly sold off and then flirted with this line and finally sunk back below it. So it's possible with the earnings coming up, with the guidance that was released from their earnings that was just released, it may not be able to break back above that resistance level. Now, for the quarter, Nvidia said it earned $1.36 a share on $8.29 billion on revenue. And that was actually up 46% year over year. So that's good. And Nvidia said that was due to record revenue in data center and gaming. Now, I knew data center would be very strong, but how did everything else end up? So data center and gaming, both record levels. Now, the board of directors also increased the extent of the company's share repurchase program and repurchased an additional $15 billion, or authorized the purchase of $15 billion additional dollars, and that's good through December of 2023. So they can use that additional $15 billion to buy back their stock anytime between now and December of 2023. So that's a bonus. That's a plus. They also increased their dividend by, oh, I don't have that number in front of me, but they did increase their dividend a little bit. It's not a huge, it's 0.1% right now. What did they, I have that number written down in my notes someplace. 4 cents. So they raised their dividend by 4 cents. What is that? A 0.09% increase. And that'll be payable July 1 for shareholders of record on June the 9th. So a little increase there in dividend. That's always a bonus, especially in a time like this when the stock is going down, right? You need to make some money. Okay, moving on from that. And don't forget, I would say go ahead. If you have questions, get them lined up now because I'm just about done with everything that I have written down in my notes here. I want to talk about some of the economic data that came out today. It wasn't much, really just two things, right? We had the conditions for durable good orders. They proved to be not great, but good in a way, kind of in between, right? And this is for April, the month of April. New orders for durable goods increased 0.4% month over month. The expectation was 0.6%. So that's why I'm not saying that they were great or anything, because they were below expectations. While new orders for durable goods, excluding transportation, it only rose 0.3% month over month, and the expectation again was 0.6%. The key takeaway is that business spending is continuing to increase, even just a little bit. Now, that view was seen in the 0.3% increase in non-defense capital goods orders, and that excludes aircrafts, which followed on last month. It was up 1.1%. So not much. It doesn't add or take away from the narrative about the economy slowing down. It's just kind of there. Businesses are spending more money. It could, honestly, it could be attributed to inflation. So not good, not bad. All right, for the housing market, that is bad. It is bad news. Total applications declined 1.2% week over week, with purchase applications flat and refinancing applications down 2%. Not looking good. Not looking good at all for the housing market. Now, looking ahead at tomorrow, investors will receive the second estimate for Q1 GDP, and it's expected to come in at a contraction of 1.3%. Remember, when the first estimate for Q1 GDP came in, it was a contraction of 1.4%. So they're expecting it to be 1.3%. We'll see how that comes out tomorrow. And we also get the weekly initial and continuing jobless claims. And we also get April pending home sales. I'm going to be curious on that one. I suspect it's going to be down. It's going to be lower than the prior month. I'd like to see what it comes out to for year to date on averaged units. Okay, earnings for tomorrow. We get Alibaba. I don't know if anyone else is still interested in Alibaba or not. We also get Costco. I can't imagine inflation's being good to Costco, but it is something that everybody does need, food. I would be curious to see with Costco. Walmart says that discretionary spending, well, it's slowed down. Well, Costco also has discretionary spending. Curious to see how that pans out for Costco. Dollar General, which is a discount store, their report. And then Gap, which is a clothing retailer. Curious to see how Gap pulls out with all the other retail misses that have been reported so far. So those come out tomorrow. Be curious to see how they work out. All right. If you have any questions, let's roll with them and let's get through it. Overall, today in the market, it wasn't that bad because we continued our rally. Let me go back to the S&P 500 here, just right quick. Actually, let me just run through these indices real quick. The S&P 500 is at resistance right now. So to me, on the chart setup, it doesn't look good because all of the worries about the economy slowing down have not gone away. This is the market wanting a short-term rebound and relief, right? Actually, indulge me here for just a minute. I'm going to go to the weekly chart. Look at us on the week, okay? We've got the 7 weeks in a row of declines. So far, this week is up nearly 2% on the week. And it's Wednesday, so that's a good thing. Hopefully, we don't lose 2% on Thursday and Friday, because then that would be 8 weeks in a row, and that would just be something else. But when was the last time on the S&P 500 we had 7 weeks in a row of losses? Do you know? I'm asking the question. I do know the answer. It was back in 2001. So let's go back here and look at this right quick. 2001. Got to go a long ways away. And this is, again, right after the dot-com 2000 bust, right? So the market actually peaked on March of 2000. And then it rallied. It tried to get to a new all-time high by August of 2000, but that was it. That was the last straw, and it fell from there. And if we're looking for 7 weeks of continuous falling, I mean, look at this. This is a bear market if there ever was one. And if we measure from that top to the actual bottom right here, it took 931 days. So this was over a year, right? Over 2 years. 931 days, and the market dropped 50%. This was a bear market. Now, the last time there were 7 days of the market falling, we have to go to, and I'm going to circle it here, we have to go to this stretch of the market right here, where we have 1, 2, 3, 4, 5, 6, 7, 8, right? And then there was another stretch back here, 1, 2, 3, 4, 5, 6, 7, right here. So 7 weeks in a row of red can actually lead to rallies, even in a bear market. If we, I don't know why I changed that color. I didn't mean to do that. If we look at after that 7 weeks of falling, okay, we actually get a nice relief rally. I'll turn that one green right here. And it wasn't all green candles, but the trend was up in this period. And this was 1, 2, 3, 4, 5, 6, 7, 8, 9 candles, so 9 weeks to get back to this local top right here. And then we fell again, had a nice relief rally, fell, 3-week relief rally. And then we went on a big fall almost to the bottom, and then had a whole month of green candles before falling again for 1, 2, 3, 4, 5, 6 weeks. And then finally we hit the bottom. Is this what we're looking at with right now? Is this what we're looking at? Because if it is, we're just getting started. I hate to say it. I really do. But we just ran up. And this, I mean, look, we have been on a multi-year bull run. I mean, look at this market just rising. We go back here to 2009 when the bottom was hit in March. And it has just been up and to the right on the chart. And we should have probably hit a recession and slowed down in 2020 or around that time frame. But we had the pandemic, tons of money coming into the market, and then we have a V-shaped recovery in the market, and then the market just completely goes parabolic and races to a top. Where else do you see the market almost go straight up like that? Going back to 1983, there's nothing. The closest thing to that, ironically, would be this stretch right here. And this is right before the 2000 bubble in the market. That's the closest we get on the chart to something going nearly straight up. I mean, it's just incredible. So there's some similarities to 2000 and the bear market that followed. And again, that bear market was over 900 days. So if that's the case, we're just getting started. But that would also mean that we could possibly be in for a relief rally. A relief rally. If it broke above this resistance right here, we could see ourselves maybe over the next month rallying and getting back to, you know, maybe 4,500 on the chart, because 4,500, that is a place on the chart that has got some resistance as well. That goes back to, as a matter of fact, let me open this box up, because this box here is sitting at 4,500, okay? Right here. I don't think I have this opened up big enough yet. There we go. If I slide this one over right here, if we had any sort of relief rally, this box right here represents the 4,500 mark. That's where we could potentially see a relief rally go to. If we can break above this local resistance right here, that would be the next stiff area of resistance. It's possible. Looking at the bear market after the burst in 2000, you had several months after falls where you had relief rallies. So it is possible. And if the Fed is talking about maybe in September we don't have to raise rates as fast, that would definitely give the market a reason to rally. So just some things to think about right here. Let's see here. Does Nvidia sell off tomorrow? I kind of think that it will. I kind of think that it will. But there's one key thing to keep in mind. Is this just a quick 2-day, I don't even want to call it a relief rally, but a forced rally? If this is just the case, then everything is going to fall tomorrow. If we can break above this resistance, then we have a chance. And let me go look at the Nasdaq real quick, because the Nasdaq has a lot of sway in what's going on. And the Nasdaq's in this falling wedge pattern right here. So it's next. And let me just pull this down a little bit and get it lined back up. Okay. So, I mean, you can see for the Nasdaq here, it came close to its own resistance today, but not as close as the S&P 500. The small caps, mid caps, those are the ones that really exploded today. So if the Nasdaq can break this resistance right here, then that's going to help the tech sector to really, really outperform. And as a matter of fact, let me do this. I don't do it much, but I want to take the S&P 500 and I'm going to divide it by the Nasdaq 100. Okay. Hold on one quick second. There we go. I had it backwards. Me and math sometimes don't work out. It's funny. Okay, so whenever, all right, so this is the Nasdaq divided by the S&P 500. So this is showing us right now that the Nasdaq is really underperforming. However, if we start to make some connections here, we start to do this. We start making some connections here on the chart. I believe we're 5% the last time I checked. Well, we're about 3% now. Right now, the Nasdaq divided by the S&P 500. This is showing that the Nasdaq technology has been weak going all the way back to November, October of last year compared to the S&P 500. And it's really been weak compared to the S&P 500 starting in, like I said, October, November. That's when it's really been weak compared to the S&P 500. That's this space right here. Come on, I don't want to do that. This space right here. So we're about 3% away from hitting this support level for the Nasdaq. Interesting, huh? All right, let's add on top of this the 10-year yield, because tech stocks are obviously affected by the 10-year here. All right, got to get this chart just right so we can see it. Okay, so typically the correlation here is when you have the 10-year going up, like it is right here in this area, right? So then the Nasdaq will be going down. It'll be weak. Yet when the 10-year is weak and it's going down like this spot, if I go straight up, you can see the Nasdaq is outperforming. It's doing better, right? So you can see that correlation. So since November, the Nasdaq has been doing horrible compared to the S&P 500. It's been underperforming. Again, that section right there. The 10-year has been going up. It got to this little bump right here. And what happened to the Nasdaq? It's kind of hard to see, but the Nasdaq outperformed the S&P 500, and it's within. Now my drawing tool doesn't want to draw. There's getting too much stuff here. Right here in the middle, and I'll change the color of this to make it easier to see. The 10-year kind of stumbled. The Nasdaq outperformed, and then once the 10-year started going up again, the Nasdaq has been going down. Now the 10-year, since the month of May, has really been going down. You can see it. It's been going down. But the Nasdaq hasn't really been outperforming compared to the S&P 500. So I'm thinking that we're 2%, 3% away from hitting this support level here, that afterwards, or maybe even earlier than, maybe we have a wick that goes down and touches this support area, but that would be the area where I would think there is more or a higher or a better risk reward chance for the Nasdaq to outperform over the S&P 500 really soon. Like, we could see it really soon. Because if the 10-year keeps falling, or even if the 10-year kind of does a standstill right here, we're only 2% away from this support area. Again, Nasdaq divided by the S&P. So I'm kind of thinking the Nasdaq is about ready to get its light in the sun, or its time in the sun, and it's going to shine for a little bit. Maybe it can outperform. Again, this is the weekly chart. Maybe we can get a 3 week or so like we did back here at the end of March during the snapback rally. So just a couple of things that I'm watching here on this. And we go to the daily view here. It just, sometimes the charts don't like to work together when you've got too many things layered on top of each other. So let's take the 10-year out. There we go. All right. Oh my goodness, all those crazy drawings. So the Nasdaq, I think it could potentially be a couple percent away from reaching this support area down here, and then start heading back up and outperforming. Just an observation there of a couple of different indicators coming together. Let's see here. And do you think it drags down the overall market? Okay, I think I might have just answered all that. We'll look at AMD too. I think I might have just answered about Nvidia, NVDA. So if this market gets rejected right now, then I think Nvidia could sell off tomorrow. And I think everything in the market could sell off tomorrow. But if we can break that resistance, then we have a chance of a short-term relief rally, just like our snapback rally that we had on Nvidia. That snapback rally, it was right here. That was the middle to end of March when we had the snapback rally. We can get relief rallies in a bear market. It is possible. I showed you that when we looked at the 2000 bubble and what happened on the chart. 7 weeks in a row of declines can lead to 7 weeks of red and green, but overall an uptrend. It is possible. Okay, let's look here at AMD is following Nvidia trend in the after hours. I bought on AMD put today, holding overnight. yeah, it is possible that it does continue going down. AMD. We looked at it earlier. It was down. It's down 2.1% still, off of the guidance that Nvidia gave, which was not looking good. Okay, so with AMD, I would continue to watch this resistance line for AMD. Again, if we don't get a relief rally between now and July, and we probably will, then we could probably see AMD around $80, $78 a share. It's possible if this resistance holds. But just remember, in bear markets, it is possible to get relief rallies, however short they may be, they could occur. Okay, hope I didn't lose you guys with that dive that we just did, looking at the Nasdaq compared to the S&P 500. But resistance is key. And if we just go look at the small caps, because they did so good today, I'll put the Russell 2000 up here. And you can see it was rejected, even though it had a great day, up 2%. Let's go to the 5 minutes so we can see this line a little bit better. On the 5 minute chart here, look, I mean, it came right to that resistance. It stopped. It was rejected. How long did it stay there? From 10:30 in the morning, my gosh, nearly to close. And then right at the end of the day, it just popped its head over that resistance area. It just popped its head right over that resistance. I know it's hard to see. These candles aren't. There we go. There we go. So you see the Russell 2000 small caps had a great day. It ran up, hit the resistance right here, stayed under that resistance, fought with it over here, and then finally broke above it at the end of the day, and then sold off, just like everything else did. The last 45 minutes to an hour, it was a sell-off. Can small caps remain above this? And if the small caps can remain above it, then is it possible for the S&P 500 to break above its resistance that it's sitting at? The black line right here at the top. Can it break this? That's the big question. And it's 4,000. So it's an easy number to follow. We closed at 39.78. Got to get above 4,000. All right. Awesome questions, guys. Anything else, let me know. Otherwise, we'll wrap it up here. If you could do me a favor, click that like button. That really helps out. Also, sharing, subscribing, hitting all the little bells and whistles there at the bottom. That helps a lot. And if you want a deeper perspective, pre-market dives on what's happening in the market, midday, fun stuff like with the FOMC minutes coming out, just a ton of information, then join us over on Patreon. Join other investors just like you and me. We'd love to see you there. So that's the first link in the description or the pinned comment in the live chat. Thoughts on Costco? That's an interesting one. Costco, with their earnings tomorrow, it's something we all need, food, but Walmart said that discretionary spending was missing, and that's something that hurt Walmart during their earnings. Costco has discretionary as well. Is that going to hurt them or not? Let's see here. Okay. I'm looking for the options market right now and what it's saying for Costco and their earnings. Okay, Costco right now, the implied volatility is 50%, and that's historically what it is. The 1-day potential that the options market is betting is a 9% swing once earnings come out. And again, that can be a 9% swing up or down once earnings come out. Earnings come out after the close tomorrow. And yeah, and that's it. So it's not a big move, not a big swing, but it's 9%. That's what the options market is predicting. Now, that's a great point. With Costco's subscriptions, since you have to, I mean, that's where they, really make that's where the profit comes from. Signing up for a subscription, good idea. That's a really good thought. That could be a really big beneficial for Costco. Let me see. I'm just looking at what BJ's did right quick for their earnings. So when BJ Wholesale, when they reported their earnings, and it was May 19th, so last Thursday, they didn't do too bad. Let's see here. BJ's posted same-store sales growth, excluding gasoline, of 4%. Its 2-year comparisons were 26%. BJ's reaffirmed their fiscal year 23 earnings guidance. That's good. So looking at BJ's numbers, which is a very comparable store to Costco, I think it looks good for Costco. Obviously, anything can happen, but this looks really good for Costco. So a question might be then, why would wholesale clubs like BJ's and Costco be performing better than Walmart or Target? So BJ's membership count reached an all-time record high last quarter, a 12% jump year over year. That's really good for Costco. BJ's gasoline sales were at record highs. Obviously, if you can go buy, your gasoline at a discount, you're gonna. BJ's gasoline sales were up 23% year over year, and they were up 51% on a 2-year stack. Oh, another thing. This helps all companies in the grocery section, When consumers are spending less due to inflation, consumers tend to go to the off-brand items. And the off-brand items are actually more profitable for the grocer than selling the brand name product. So that could be a key to BJ's performance and a potential guider on Costco's performance as well. Let's see here. So it looks like overall, BJ's had a good quarter, and that bodes well for Costco. So I'm thinking Costco is going to do pretty well, or at least they have a good chance of doing really well. And looking at the chart here, I mean, they're low. They're underneath an area that I thought should hold support, and that's at 440. I mean, it's just now climbing back to that $440 a share area. Even though old support can become new resistance at times. So, I don't know. I think it looks good. What are they calling for here? $3.04 a share, 51.5 billion. So last quarter they did $2.92 a share for EPS. So it's up slightly. Okay. All right. Big Lots should be interesting too. Yeah, it's a discount retailer. Yeah, that could be an interesting one. Awesome. Okay. So Costco, I think Costco's got a chance tomorrow. I think they've got a chance to definitely be interesting to see about guidance. How's that going to affect? I didn't look at guidance for BJ's. Oh, yeah, I did. Yeah, I'm hoping Nvidia sells off too. If Nvidia does, and I think it will, I don't know by how much, obviously, but if it can get in this box, I'm telling you, sub 150, 130, 135, that would be excellent. That would be excellent for Nvidia. So 130 or better, that is definitely a good goal to have. And, when Nvidia first pulled back and then, bounced back here in December, people would have thought we were crazy talking about Nvidia sub 150 or coming down below 130. But it is definitely doable. And I think it's coming. That's why patience is so key. So key. All right, well, I'll go ahead and wrap up today. Thank you again for your questions. I greatly appreciate them. I greatly appreciate you being here every day with me to talk about this crazy market. It is fun. Hopefully we can learn and make some money. and retire young, right? Or at least make some money. Who wants to retire, really? It's just fun. It's just fun. You are welcome. Greatly appreciate it. All right, so I'll go ahead and wrap it up for this evening. Thank you so very much for joining me today. I'll be back tomorrow after the market closes, as usual, and I'll look forward to talking to you then. And remember, investors on Patreon, I did send out yesterday evening the momentum stocks for this week. So if you haven't checked those out yet, make sure you do. But then again, we need to be careful. After 2 days of green-ish in the market, we do have to be careful about what tomorrow might bring. We could have a rally. We could have a sell-off. It's really a flip of a coin. I hate saying that. I wish I could be more predictable on that, but we have just been declining so fast and so far that you got to think a relief rally is coming at any moment. Just physically, most investors just can't hang on to that. I know capitulation hasn't occurred yet. That's how I know that we're not at the bottom yet. But like I showed you with the 2000 and 2001 bear market, you can get weeks and weeks of green. So we just have to take it day by day. And yeah, that's it. All right, I'll wrap it up. Thank you guys so very much. And I'll see you tomorrow after the market closes. Take care. Good night. Have a good one.